Let's go, folks. Good morning, one and all. Welcome to the Street's opening bell here from Post 35 on the floor of the New York Stock Exchange. Today is Tuesday, the 25th of October. Happy almost Halloween. I'm your host this morning, JD Durkin. Opening bell rung just moments ago here on the floor of the NYSE by Granite Ridge. Stocks continuing their momentum once again in yesterday's session after the best week that we've had in months across the major market indexes. The S&P adding 1.2% yesterday's session. The Dow 30 up 1.3%. The Nasdaq adding 0.9% as well. 9 of the 11 sectors in the S&P finishing the day up in yesterday's session, led by healthcare and consumer staples, though energy and industrials are the sectors having the strongest month out of the 11 so far. And it is so far the best month, in fact, for the Dow since November of 2020. Let's now turn our attention to what is on tap today. We will be breaking down the markets and everything that you at home, need to know for the trading session today and what the rest of the week may hold. We'll also get into some earnings. We did have big news from Coca-Cola earlier today. We'll break down their solid quarter and preview what may be on the menu after the bell when Alphabet and Microsoft report as well. For more on those stories and so much more, we now bring in our senior editor and chief markets correspondent, Mr. Martin Baccardax. Martin, good morning to you. No shortage of things to talk about. And we always say that, but some days it's more true than others, and this is one of those days where it's really true. The S&P 500 is at a 5-week high. Any reason to think that might not continue this week? I know there's a lot of economic data and earnings information that's going to cross the tape. What are you following?
Ultimately, I think the performance is going to hinge upon what we hear from the big tech companies after the closing bell today, Microsoft and Google, and then again what Apple and Amazon have to say on Thursday. Collectively, of course, those are the four largest weights on the S&P 500, and if they aren't able to deliver on the second quarter numbers, then this momentum is going to be very difficult to carry forward into the final months of the year. I think some of the other tailwinds that we're seeing, of course, are perceptions of the change in messaging from the Federal Reserve with respect to their interest rate hike plans. The assumption now is that we'll get that 75 basis point increase next week. That will take us to 4 consecutive 75 basis point hikes, and on the path probably to a Fed funds terminal rate somewhere around 4.6, maybe to 5%. But we could have a bit of a slowdown in rate hikes into December and beyond as the Fed looks at the impact on the broader economy. And certainly recession risks are brewing in Europe, in Asia, and indeed elsewhere. Asia stocks, for that matter, are trading at the lowest levels in 2 years. So the momentum is solid now. The month of October, traditionally a strong one, is performing well, as you suggested, the best since November of 2020. But there is still a lot to play for. There is still an inflation reading that will be key to market perception on Friday. And we still have those big four tech earnings. And you wouldn't want to put a whole lot of money on the table before those numbers because they are simply just so important for the broader market performance.
Absolutely. I do want to get your perspective here. Let's dive into earnings. You and I could fill an entire hour-long show plus just talking about the earnings that we've had already, and especially with an expectation towards the future for sure. So let's start with Coca-Cola, company raising its full-year outlook after posting better-than-expected earnings. This, of course, follows PepsiCo's big beat last week. Maybe we shouldn't be surprised here. Maybe the writing was on the wall a little bit for Coca-Cola. Pepsi last week also raised its full-year forecast for revenue growth. How did Coca-Cola compare, and what more did we learn, Martin?
They're not as much apples to apples as they used to be, JD, simply because PepsiCo now gets such a revenue growth drive from its snacks division, Frito-Lay in particular. But Coca-Cola, from a beverage point of view, certainly did well. They were 11.1 billion in overall sales, a firm gain from last year, and they beat again on the top line. And as you suggested, they boosted their full year outlook as well. It certainly appears to me, JD, that it's pricing power more than anything else that's driving those gains, because actually case volumes, the best way for investors to look at growth in terms of expansion of the beverage market for Coca-Cola, were only up 4%, where I think revenues were up closer to 9 or 10%. So that certainly suggests to me that the pricing power was probably the most important dynamic in that earnings beat, and the organic revenue forecasts are very solid, suggesting to me that the dollar headwinds are still in place. In other words, the organic growth numbers are those that strip out currency impact. Now, Coca-Cola typically reports in that fashion, but nonetheless, it's indicative again of the headwinds the companies are facing as a result of the U.S. dollar strength. And Coca-Cola is, a global business unlike pretty much anyone else's, so it's going to be impacted more so than many others. And it was interesting to me that they still see those gains despite the dollar headwind.
One of the things we heard from the PepsiCo CEO last week is to say, for all the conversation about inflation and how tight, how difficult things may be for the consumer, Martin, his argument was to say, at the end of the day, people are probably still willing to spend a few dollars on their favorite drink, on their favorite snack. He thinks that positions PepsiCo well for the future. I'm curious if we have any sense that, even if they don't have the Frito-Lay component, that Coca-Cola can still adhere to that same principle, especially in the face of skyrocketing inflation.
They certainly appear to be. I think, the price strength is probably the most important dynamic for the numbers. But we talked about this as well with respect to PepsiCo, JD, and that's the fact that the away from home channel sales are growing so well simply because the rest of the world is back up and running in terms of their out of home activities, stadium, theme parks, movie theaters, and all the rest of it, which, typically account for a significant amount of beverage sales, both for PepsiCo and for Coca-Cola. So not only are you getting resilience from the consumer, particularly with brand strength when it comes to companies like PepsiCo and Coca-Cola, but you're also getting a tailwind of the reopening and the consistent maintaining of opening for all these other away from home venues. And that's been an important component for the earnings growth as well.
The mixed bag, so to speak, of this earnings season continued. We also got news out of GE today, weaker than expected. The company there, General Electric, lowering its full year profit forecast, Martin. I wonder what more did CEO Larry Culp have to say? I know this was one of the many, many stories you wrote about this morning up on the site.
Yeah, big parade of earnings this morning. GE is always an important one. For the longest time, it was seen as a bellwether and a sort of like a beacon with respect to U.S. economic growth. It's less so now, of course, and as a result, it's splitting into three different companies. Ultimately, by 2024, they're going to have an aviation unit, a power and renewables unit, and also a healthcare division. The healthcare division will be up and running as a standalone next year. The company had a 1-for-8 stock split earlier in the year. So looking at it from a year-on-year basis is very difficult because there are so many moving parts. As a result, investors tend to look at free cash flow rather than the bottom line earnings as their guide for where the company is headed. It's a little bit more of a pure mechanic that investors can focus on, which sort of it keeps a steady line through all of the corporate changes to the balance sheet, to the income statement, and everything else. Free cash flow was very solid in the third quarter at $1.1 billion US. Larry Culp said that's probably going to grow significantly again over the fourth quarter. They held to the previous guidance of free cash flow of $4.5 billion for the year, but based on what he is saying, investors do suggest that it's probably going to be a little bit higher than that. That would be a healthy performance for a company that faces not only dollar headwinds, but input cost headwinds, and indeed the broader impact of a global economic slowdown. So Culp is performing well, I think investors are saying, despite all of these difficulties. And that's why the stock, in my opinion, that's why the stock was able to reverse its earlier gain when they first looked at the headline earnings and then drilled down into what has become the more important metric of free cash flow.
Absolutely. You want to talk a little UPS now? Or is there another top company for earnings? Because I could drive the conversation because there's no short. I just don't know if in your brilliant brain there's another company specifically you want to go to. But I would like to talk UPS if you want to go there.
UPS is as good as any, JD. I think it's an interesting performance, certainly with respect to what markets looked at with FedEx a few weeks ago. They were very disappointed with execution at FedEx and didn't really like what the company had to say about broader global demand. Now, that demand picture doesn't change for UPS. UPS still has to sort of manage itself in the same macroeconomic environment, but they do seem to be executing at a much more efficient pace, and they do seem to be able to pass on price increases, at least domestically, in a way that seemed to surprise investors to the upside. Price per piece, in other words, the amount of increase that they put into each package delivered was up about 9.8% from last year. So that's ahead of headline inflation rates, and certainly ahead of inflation rates that we've seen from at a producer price level as well. So robust gains, that was able to drive revenue growth. Domestic more than offset relatively tepid gains for its international segment. And indeed, UPS was able to they actually hold on to the 2022 guidance, and the stock is up firmly this morning. It's just such an interesting company in comparison to FedEx at this point, because execution is so much more, is being taken much more smoothly than its larger FedEx rival.
So no indication there in what we heard on the call to indicate that the company, the UPS, might not be well equipped to handle the very important holiday shopping season. Did that next quarter of guidance sort of come up? Because you'd really have to imagine that's, arguably the most important point of the year for UPS.
That's such a great point, JD, and I think we'll know a little bit more, certainly from the conference call itself. I haven't been able to go through the transcript just yet, but also what Amazon has to say about its holiday quarter forecast after they report later this week. Amazon being a significant but slowing component of overall revenue for UPS. They've been at pains to tell investors that they aren't necessarily as hinged upon Amazon performance as they used to be in the past, but it's still an important dynamic for the company. Capacity has been an issue for virtually everyone, though, JD, as a result of these very tight labor markets and the fact that companies are having to pay increasing costs to keep people employed, particularly seasonal employees, which many companies such as Amazon and UPS rely upon heading into the holiday shopping period. So I think that is a really important component to look for. We'll get some measure of it from the conference call with UPS executives, and then ultimately a clearer indication when we hear what Amazon has to say on Thursday evening.
Absolutely. I do want to talk Alphabet briefly, if we can, to any degree, because I'm sure you'll be covering it closely. They were set to report after the bell today. The company did outperform the S&P more broadly in yesterday's session. We are projecting revenue just north of $71 billion. Any top-of-mind expectations for you? And I also wonder, for a company like Alphabet, Martin, are there things that you know to pay attention to that the rest of us honestly may miss?
It's a funny one, isn't it, JD? Because I think most of us just have a very sort of a static experience with the way that we interact with Google. It's a search engine. We don't give it too much thought. We find what we want, and then we tend to drive on. But as a result of the fact that so many of us go to it as our principal form of internet search, it is the global leader in digital ad sales. So therefore, what it has to say about the strength in that market is incredibly important. Far more so, it has to be said, than Snap. I mean, even if you were to drill down into YouTube, you see that annual revenues there are about 29 to 30 billion US dollars in terms of ad sales. That's just for YouTube alone. That's about 5 or 6 times more than the entire year's revenue for Snap. So therefore, whether Snap sees weakening spending is one thing, but the YouTube and Google more broadly see it is quite another. So really, we are going to be looking for the forward guidance from Google into the final months of the year and beyond to understand where we stand in terms of that digital ad revenue space and the strength within. Cloud is also an important component for growth in Alphabet as well. Their web services division is starting to challenge Google and Microsoft, and therefore it will be important to see what they expect in terms of corporate buy-in and cloud expansion and hybrid growth and all the rest of it. But the numbers are really, really strong with respect to their growth rate in the ad spend space so far as the market leader. But for me, JD, that's going to be the principal focus for investors later today, what they have to say about ad spending going forward.
To this point about ad spending, if I'm not mistaken, it was just last week here on the broadcast, Martin, you referred to Snap as the Iowa caucus of tech stocks. But as we certainly know, just because you win the Iowa caucus does not mean you win the nomination, and things don't always go as we expect. Is there anything, I wonder, to keep in mind from Snap advertising? Anything we learned last week that helps in terms of better understanding Alphabet, or is Alphabet just an entirely different beast that's barely even in the same conversation? No disrespect to the folks at Snap, but are we talking about two entirely different universes here?
Yes, I think so for the most part. If Snap is the Iowa caucus, then Alphabet is Super Tuesday in and of itself. It's the game changer with respect to what it sees in the digital ad marketplace. But what is common to both, JD, I think, is the fact that TikTok just continues to take market share, whether it's from Meta, whether it's from Snap, whether it's from Google. It's a behemoth in the ad spending marketplace because of its grip on certainly a certain demographic in countries all over the world. And that, of course, are those in the late teens and early 20s. It's one of the principal forms of entertainment for most of them. The algorithm, as critical as you might be of it, is extremely powerful in inducing deeper engagement times, and therefore that's exactly the kind of thing investors are looking for. They want more engagement time and they want growing user bases. TikTok is delivering both, and therefore that is implicating not only the potential for market share growth for both Snap and Google, but also the changes in their business dynamics as well. YouTube is offering more and more short reels that are similar to what we see on Meta and TikTok in a way to capture that younger audience in short form content that they can then turn into digital ad sales. So whilst the companies are very, very different, the TikTok element to both of them is probably the one constant. It will be interesting to see whether the company mentions it by name.
You know, to the point about mentioning companies by name, I'm thinking back to when Mark Zuckerberg has been on Capitol Hill before, and he takes these indirect, not very thinly veiled shots at TikTok to say, basically, I'm paraphrasing here, but to basically say, at least we're an American company, senators. And I think the same could be said if you're an Amazon or you're an Alphabet. You say, at least we do our operation here in the States. And I think they use that argument as a little bit of a pushback against the growing market share influence of a TikTok to say, well, hey, you may not like us, we may not be perfect, and we're in favor of good faith regulation, but at least we're American based. And I wonder, before we move on, I hadn't planned to ask you this, but is there a specific take that you have on TikTok? Because that speculation has been growing. Maybe the DOJ, we first got this under the Trump administration. Maybe the Biden White House would look to do something more forcefully on TikTok. It's not entirely clear what, but I don't know if you and I have really talked TikTok on the show before. Are you a TikToker, Martin? I guess that's the first question.
I dabble in it. It's interesting for sure. It definitely has some entertaining content, and the ease of use is really quite arresting. You can find yourself spending time on that without even noticing, and that does speak to the power of the algorithm and the ease of use of the platform itself. But we've had an asymmetry from a technological perspective to the way that America deals with China for quite some time. The reciprocation simply doesn't exist. The companies are not allowed to have their messaging platforms up and running in China as a result of state censorship. There are all sorts of restrictions on the sale of US made technology in China that simply don't exist here in the United States. It is starting to change, of course. The US is cracking down on selling significantly advanced artificial intelligence technology to China and chips related to it to prevent sort of IP theft and other things, and prevent China from maybe using that technology to spy on US citizens. But what really surprises me, JD, is that TikTok has been able to amass such an enormous amount of US market share whilst gathering data from the user base and allegedly gathering data from a user base which is probably not old enough to be making decisions about sharing that very personal data in the first place. While they've been able to do that against only really modest pushback from the US government is interesting to me, maybe and simply because the relationship between the government and other tech companies has been so fraught for a number of years that they haven't been able to sort of marshal their collective lobbying effort and get the government to crack down on TikTok in a way that I think a lot of people would say it probably should.
Yeah, absolutely. Many people are saying that, and they will continue to say that, I have no doubt. To go back to earnings here, and thank you for that. I just saw the window to talk a little TikTok. I'm always down to talk TikTok. But we will hear from Microsoft today, and I'm interested, with an eye towards the future here, what you might be tracking there. Here's a look at what a Guggenheim analyst wrote last week on the stock. They said all eyes will be on the company's ability to maintain 2023 guidance for reported double-digit revenue growth. And here's the key one, Martin, which we believe is at risk. The company makes, Martin, more than 50% of its revenue outside the U.S. And I wonder how nervous you are, if you are Microsoft right now, about the strength of the greenback, the strength of the U.S. dollar.
You absolutely have to be, JD. And I think that focus is absolutely correct, because if you go back to the second quarter earnings over the summer, Microsoft's numbers were relatively weak on face. The stock traded notably lower after the initial results, and then gained momentum afterwards when Microsoft issued that full year revenue forecast of double-digit growth. So holding on to that will absolutely be key to stock performance going into the final months of the year and beyond. Microsoft is down about level with the NASDAQ and a little bit less than, excuse me, it's down a little bit more than the S&P 500. So much like the bigger tech stocks, it hasn't performed terribly well this year. But the assumption is that the momentum it could take into 2023 will be very important for market direction. I happen to agree with that thesis as well. But we're looking for revenues somewhere around the $50 billion mark. Ultimately, the diversification of Microsoft's business will be good for it. In other words, the fact that it has, PCs, PC services, consulting, it has the web services division as well, are all important components of its growth. Indeed, its gaming division is another one. But of course, are they diversified enough to fight against that US dollar headwind? Greenback is up about 17 to 18% against its global peers this year alone, trading at a close to 20-year high. And that is certainly going to impact the kind of profits and revenues that it generates in these overseas markets. So there is a lot to dig through in Microsoft numbers, but I think that analyst assumption of the ultimate direction being hinged on what they have to say about revenue growth is absolutely correct.
Absolutely. One thing that Microsoft focuses a lot of its time on its earnings call on is Azure. Of course, that's the cloud services unit. Are you expecting that to be a little bit of a silver lining at all, especially in light of what a lot of analysts expect will be a call that's, largely focused on talking about a lot of these headwinds that the company is facing?
Yeah, Azure numbers are always super important for Microsoft direction, but they can be a little bit misleading because the Azure growth numbers come before Microsoft issues their forecast for revenues and profits into the final months of the year. So there might be about a 30 to 60-minute gap between when we see that growth figure and when Microsoft guides us on Q4 revenues. So I would be mindful of that as an investor, but I would imagine that we'll see still solid growth rates, although probably slowing from the pace that we had in the second and first quarter, simply as a result of the broader conditions that we're seeing in both the cloud and hybrid cloud markets. So an important number, but one that actually might give investors a chance for a bit of a head fake heading into the conference call when everything is to play for.
You were alluding to this at the top of the broadcast. I wonder how likely it is, Mart, we may end up seeing huge market swings one way or the other based on the market cap and just the massive size of some of these companies on tap, like an Apple, an Amazon, or an Alphabet.
I really do think we will, JD, and I have no evidence to support this. It really is just an anecdotal observation, but it seems to me that might be part of the reason why these companies tend to post their earnings after the close of trading, because there is such a significant amount of time for markets in the United States and indeed elsewhere to digest the numbers. If you were to post those numbers at maybe 7:30 in the morning on a typical trading day, when the market only has about 90 minutes to pick through it, you have much more significant swings as a result. And of course, as mentioned, the four companies, Microsoft, Amazon, Alphabet, and Apple, are the four heaviest weights on the S&P 500. So their movements have an outsized importance to the overall market direction. So there is something to say for it coming after the bell. And I do believe, and again, this will be the case today, we'll probably see a big difference between the initial market reaction and the dig through once we understand what the company has to say in the conference call.
Martin, moving on now to a story that I truly wish, I think we all wish we didn't have to talk about, but since there is a market implication for Adidas, it's an important one to underscore on the broadcast today, especially for people waking up yesterday or today and seeing, at least today, Adidas cutting ties with Kanye West. I do want to pull up what the statement is from the company, largely in defense of its decision here, which they shouldn't have to defend, but they did address it. They said Adidas does not tolerate anti-Semitism and any other sort of hate speech. Ye's recent comments and actions have been unacceptable, hateful, dangerous, and they violate the company's values of diversity and inclusion, mutual respect, and fairness. And we can all agree that those comments have been unacceptable, hateful, dangerous, and yes, anti-Semitic. Q4 is huge for a brand like Adidas. Obviously, you've got the deeply human, concerning part of the story, which is most important. There's also a market implication for Adidas, and since that's what we focus on, I want to make sure that I do get your take on that. Q4 is huge for a brand like Adidas for the holiday shopping season. What does this tell you, especially given where we are in the calendar, about all the factors that a company like this has to take into consideration to make a decision like this?
Well, I think you put it well, JD, because in these times, companies have been called upon to act. No, I don't like the term moral arbiters. I really don't think that that's necessarily accurate. But companies do have to reflect the sort of moral compasses of the people that buy their products. I don't believe that companies can simply sell goods and services in a vacuum, look for profitability, and then just carry on as if nothing can happen. Companies have an outsized importance in both public and private life these days. They are integral in terms of our understanding of cultural dynamism and significance, and no more is that so with a case like Adidas, where they purposely brought on an artist and a designer and a singer who has a particular cultural standing in the biggest economy in the world. Now, the fact that they cut ties with him suggests, of course, that they are looking at things beyond profitability. I think that's absolutely correct, because the comments were simply repulsive. But the fact that they took this long to do so maybe raises questions about exactly how they are trying to define their corporate identity in a world where these expectations about responsibility seem to be ever changing. The one point of defense I would put forth in Adidas's instance is that the ability to take these decisions is a lot more complicated with German companies than it is with American ones. These discussions have to be taken at a board level, and the board is a lot more complex in terms of its composition than most American companies, because they include, amongst other things, people that are represented by a union member on the shop floor. In other words, Adidas employees have a say in these big decisions in the same way that the CEO does, that the chairman does, and other senior executives do. Bringing those people all together to discuss something as important as this isn't as quick as it might be for a US company where the CEO is also the chairman and can largely make these decisions at the turn of a dime. So a small amount of defense, I guess, for Adidas for doing the right thing, but taking so long to do it.
Yeah, absolutely. Okay, let's move on now to our rapid fire here, if we can. Martin, if you're ready for these. And I do want to start with Amazon. That company put in a hiring freeze on its cloud division. First up, has the company gone cold?
This will be an interesting one to pick through. Obviously, we'll get more detail on Thursday, but the New York Post said that the company is having a hiring freeze in that web services division, which of course is extremely lucrative. It's about 15% of overall revenues, but it's growing much faster than retail revenues. And it's a really important and massive component for the broader business of Amazon, even though it's one that most people aren't necessarily aware exists. The New York Times reported earlier in the month that the company's freezing hiring at some of the higher retail levels as well. So that does suggest a little bit concern with respect to broader demand. The New York Post story, though, was maybe a little bit more thinly reported, not necessarily suggesting it was incorrect, but it didn't have the depth maybe that some investors were looking for. The shares are going to be weaker, but we will see what the company has to say about hiring and demand sort of the expectations on Thursday evening.
Absolutely. Okay, number two, something that is top of mind for many people, not just here at home, but really around the world. What did Rishi Sunak say in his first public comments officially as UK Prime Minister?
He basically said that the company's facing a profound economic crisis, and those were words that people really don't necessarily want to hear, but certainly probably have to absorb as the country moves into recession that is going to be paired with a double-digit inflation and an energy crisis. There are decisions that have to be taken both at the fiscal and indeed monetary level that are going to be uncomfortable for any leader. And Rishi Sunak certainly has a difficult task ahead of him. He also has, of course, the difficult task of trying to unite a Conservative Party which has been fractured by these leadership debates and contests and the resignation of Liz Truss, the resignation of Boris Johnson, and, of course, the fact that it's been plummeting in the polls in terms of broader popularity. The opposition Labour Party is pushing for a national election. Sunak, of course, is going to resist that as he tries to get a budget in place in the next few weeks. But with so much dissension amongst the Conservative Party ranks, you do have to wonder if he can get that through, and indeed, if he cannot, whether he'll be forced to call an election. So whilst the markets have been placated by his sober assessment, he still has to deliver, and it is a long time between now and Christmas. And many people are saying we're probably going to have an election at least sometime early next year.
All right, third and final for our rapid fire round. I don't know. This was a strange Monday night game because all the prognosticators say, well, it's definitely going to be under. It's definitely an under game, and it clearly was not. Zappy Hour in full effect. What did we learn from the Patriots? The Bears-Patriots game. Wait a minute. It says Pats win over the Bears. Did the Patriots win this game?
No, the Bears did win. Yeah.
That's what I thought. Justin Fields had himself a day. Zappe played great, for whatever it's worth. But now, I feel like there wasn't a quarterback controversy officially in New England this time yesterday, and right now there is. What did we learn from Mr. Zappe's performance or elsewhere in the game?
I mean, for me, JD, I guess you just learned how ruthless the NFL is. I mean, Mac Jones was the darling of the Patriots last year. He seemed to be executing the offense in a way that Bill Belichick had asked, and he was indeed fulsome with praise for the young quarterback from the University of Alabama. Well, our interception and 3 series into the game against the Bears, and he was on the bench. And Bailey Zappe was in. He played well, and now there is, of course, the suggestion that Zappe is going to take over the stewardship of the team. And all of that, of course, overshadowed a really good night for the Bears. And it just, again, once sort of crystallizes the fact that quarterbacking in America's most popular sport is the most important position. And when you have a controversy like that, the chances of you performing well are not great. And the ruthlessness which with Jones was hauled off the pitch last night was something to behold. I ended up, JD, I have to confess, I felt quite badly for him when they were showing him on the sidelines, because it was clear to me that he didn't expect to be pulled as quickly as he was, and now he's going to have to be extremely professional to keep his emotions in check as a result.
Yeah, it's such a tough position, right? Because obviously it gets talked about on television. The camera there on the sideline showing the side-by-side of the two of them. I mean, it's like showing you and me in the 2 box right now. It's just one quarterback who's, obviously, like you said, very good. This guy Zappe's just been an absolute phenomenon up there in New England. You hear the pressure. But nonetheless, here we've had this whole conversation, didn't even give the Bears their due. I mean, the Bears won the game. Justin Fields looked good. They actually did what they had to do. Our friend Ross Mack, who does content for us here at the Arena Group, huge Bears fan, and I was texting him throughout the night, and I couldn't believe how well they played. But my other question for you before we wrap up is, what are we supposed to do here the next 3 nights, I guess the next 2 nights, with no football and no baseball?
Speak to our families. I mean, that might be one thing that we could possibly execute, isn't it? And the NBA season is upon us, JD. So if speaking to your family is not necessarily at the top of your bingo card, there's at least a chance you can catch the Lakers lose another game between now and then.
Hey, absolutely. We do have that. We got the Knicks here. Knicks got a win last night with Jalen Brunson here at the Garden. A great show, a great conversation as always, Martin, and a very busy earnings week. So I do encourage everyone, tune in again tomorrow and every morning we do this here to get Martin's perspective for everything that you need to know for a very, very busy week, an important one for investors. Martin Baccardax, thank you.
Thanks, mate.
All right, that's going to do it for the market open here from the floor of the New York Stock Exchange. Stick with TheStreet.com for more on these and all of the major market stories that matter to you. We'll see you tomorrow.